Hey, party people. Welcome to this week's Money News in Human Words, where I help you understand the key messages behind the headlines and what you need to do to be smarter and make better investing decisions. Now, it's been a really big week this week. A ton of stuff going on with all of the disruption in the global economy. The inflation and interest rate thing is a thing, and it's happening everywhere. So there's a bunch of stuff to unpack. The first thing that caught my attention over the last week is that CBA and Westpac have just cut their fixed rates by 1.6% in the first sign that the rate rises we're seeing could be over sooner than most people think. Now, CBA have already come out and predicted inflation will come down at a faster rate than what the RBA has suggested. And if rates start coming down with unemployment rate at record low and wages forecast to rise strongly over the year, my take is that the property market could potentially bounce back fairly quickly from the softness that we're seeing at the moment. Regardless, this is welcome news for borrowers, no doubt, particularly those on fixed rates, of which 75% are going to see they're due to have their fixed rates expire in the next 12 months, and for those borrowers, they're likely to see interest rate, an increase in their mortgage repayments of around 40%. So the fixed rates offered by CBA and Westpac have been, they're just below 5% for a longer term fixed rate, which still seems quite high relative to the current rates. However, significantly lower than what we've seen over the recent past. And I think it lines up with what the CBA have forecast around inflation coming down. I mentioned last week on the podcast that the single strongest driver of property prices is sentiment around property. It's the one factor, not so much what's going on in the economy, what's going on in investment markets, what's going on with inflation or interest rates or anything like that. The one data point that has the strongest link to property prices in Australia is sentiment. And at the moment, I'm seeing a lot of people that are fearful around property, and probably with good reason, with rates rising in the way that they have. But I'm also seeing a lot more and an increasing number that are ready to pounce on the opportunity. So I think if we get a few other data points working in our favor, things could move fairly quickly here. And look, it highlights that if property is something that's on the roadmap for you, really, really important, get your ducks lined up now, know what your strategy is, and be ready to rock, because if things start moving quickly, you don't want to be the one that misses the boat. Keeping on the property theme here, I saw some data and a piece on the fact that residential property investors are ignoring the massive increase in interest and mortgage costs to pick up bargains on rental apartments. So they're prepared to ride down some of the biggest property market decline in value for the last 40 years. Now, the latest borrowing data that's come out from AFG, or Australian Finance Group, which is a big mortgage aggregator, they call it, it shows that investor lending increased through July to 28%, and now at the highest level in the last few years, with property investing activity recovering strongly after the election victory from the coalition back in 2019. So what we're hearing from a lot of property buyers agents is that investors are attracted to the record low rental vacancy rates, which are driving a massive uptick in rental yields, and a property market that's favoring landlords over tenants. They're talking about we're seeing property rental increases of 10% and looking like something like 15 to 17% by the end of this year. So looking at some of the core logic data, we see that rents have increased by more than 30% across inner Melbourne over the last 12 months. And that's all when there hasn't been that much demand from immigration with all of the COVID stuff going on. Across the whole country, the gross yield, so the total rent, so gross rent before costs, has increased to about 3.9% in June, with Perth being at 5.5%, Melbourne at 3.7%, and Sydney at 3.3%, according to CoreLogic. So what that says is that the yields are the income return that you get on a property. And don't forget that when it comes to property, that the bigger return, even bigger than the rental income yield, is the growth that you get on the property value, and the return for the last 100 years, about that 6.8%. And that's on top of those rental yield numbers that I just mentioned there. So what we're seeing is that from this data from SQM Research, they seeing a national record vacancy rates at a low of 1%, which is basically half of what the average vacancy has been over the last 15 years. But looking at the data and diving a little deeper, we're seeing that it's not the same in all markets. So in regions, we're seeing potentially a bit of a peak in rental vacancy rates and a bit of a drop off in rent. In my view, there's probably no surprises there, because we see a lot of people move to the regions, big flows up through COVID. Then the flood crisis, that has had a big push in rent. We work with a number of people that were impacted by the floods in southeast Queensland, driving up rents massively because nobody could get a place. And I think as people realize that maybe living in the regions is not quite what they were, the romantic notion that they were expecting in the middle of COVID, that there's a bit of a drop off in demand, and that's softening rents. House prices are falling. There's no doubt about that. Looking at some commentary from Morgan Stanley showing that they've declined by the fastest rate in like 40 years as interest rate rises are applying pressure to borrowers, and credit availability as well, with prices ending up about 2.6% below the peak levels, led by Sydney, Melbourne, and Brisbane. But they're talking about more falls to come, potentially around that 10% by the end of the year. And look, again, I think highlighting that it's not all markets impacted in the same ways. It depends on where you're buying. We're seeing strong performance in property prices, and property prices holding up quite well in certain areas, more impacted in others as well. But look, I think the message through this is that we are still getting good income yields on properties, in addition to the growth that you see over the longer term. And the smart investors are coming in now with recognizing that the downturns are the periods where the money is to be made. The next piece, and looking across the broader economy, is that we've got significant wage growth expected in the next 12 months, with 60% of businesses expecting wages to rise by more than 3%. So that's the fastest rate of increase in some years. So in fact, over a decade, according to RBA data. But because of the record high inflation that we're seeing, it's likely that real wages, so wages less inflation, are still projected to go backwards until 2024. So looking at what's driving that, it's no surprises with headline inflation forecast to peak at 7.8% later this year. But look, I suppose at least we're not as bad as England, who are looking at 13.3% projected inflation, and potentially quite a long recession over there. It puts the RBA in a pretty difficult position, trying to balance rising interest rates to slow inflation, but at the same time doing it in a way that isn't going to send the economy into a massive recession. And look, off the back of a lot of criticism from the punters about the RBA's handling of recent events, many people are really questioning whether they can do it, and whether how accurate these forecasts are. As I mentioned in that previous piece, CBA is forecasting inflation to fall much faster than the RBA, back into the target band by the end of next year. So look, I think time will tell on that one. Sticking with jobs, and the US jobs data just came out last week. That came in at a record sort of 528,000 new jobs being created, which went ahead of all of the estimates. The unemployment there is now at a five-decade low of 3.5%, and wage growth is accelerating according to their labor department over there. What that does is it adds to the case for the Federal Reserve, which is the central bank in the US, to increase their interest rates over there by 0.75%, which is a supersized rate rise in September, to cool that inflation, which is currently at a 40-year high over there. Also suggests that the Federal Reserve may need to keep their interest rates in the US higher for longer, which is really sort of in opposition to what the market is expecting for rate cuts next year. What we saw when this data came out is that there was a big spike in bond yields. So bond yields in the US on the expectation of higher rates. The market's got a strong indication that they're expecting 75% or 0.75%, so 75 basis points increase in September. And look, given that the US leads the world economy and has the biggest investment market in the world, how things play out there is really going to have a big impact on investor outcomes for the 12 months ahead. Looking at the Aussie unemployment and unemployment and jobs data, that the jobless rate is forecast to fall to a record low of 3.4% in Australia and stay below 4% until 2024. Which creates a strong case for wage growth, because as the market gets highly competitive, people need to pay more for growth and keeping people in their businesses and teams, which is no doubt welcome news for people that have been struggling with the higher inflation and interest rates. But the downside potential to keep driving inflation up, because as people get more money, better able to deal with rising prices, which means that they can keep spending at a faster rate than if they had less money. Sort of makes sense, but obviously not a good thing when it comes to inflation and interest rates. So RBA's forecast inflation to stay at 6.25% through the first half of 2023, then come down to 4.25% by the end of next year, the end of 2023. But worth taking that one with a grain of salt, because it compares to their May forecast, where they looked at 4.3% by June 2023. So basically 2% less, and below 3% by the end of next year. So a big jump up there. They noted that a big reason for the change in their forecast was the pass-through of upstream cost pressures in many sectors. That's their words, not mine. Essentially, suggesting that because costs are rising in a lot of areas, that businesses are passing on those costs upstream. I think they realize that they can. I know, you only need to go to the supermarket to realize that there's a bit of piss taking, I think, going on when it comes to some of the price rises that we're seeing, because they know that people are sort of expecting it. So I think, welcome news for people in the employment market, but potentially adding a little bit of trickiness to the inflation position in Australia. Switching gears a little bit, talking tech and tech investments. Last week we saw Canva, the market darling, the value of Canva written down by $14 billion, or 36%, in a sign that the tech sector has been battered and is not immune from what we're seeing in the economy at the moment. Canva they raised their value from 15 billion to 40 billion during the period from April 2021 to September 2021, which is pretty staggering. We've got a bunch of clients that work with Canva, and them, like a lot of people, have fallen into that trap of thinking that the only way is up when it comes to tech. And this shows that this clearly isn't the case. I think that there's a big lesson here for investors, that tech and early stage companies in particular can perform really well, but it's not without its risk. Now, Canva have used funding in the past to drive their further growth, and with more, they've historically had more investors that want to give them money than money that they actually wanted to take on. So they're not used to being in this situation. I think that it's an interesting one to watch, to see how things progress for them throughout the rest of this year and into 2023. But look, it's not all bad news for tech. Atlassian released their earnings last week, and their share price went up by over 10% off the back of their earnings data, increasing all market expectations. They had a quarter booked revenue of $1 billion US, which is up 34% from last year. And it goes to show that there's still some good news in tech for companies that are doing well, particularly companies that are making money. Welcome news, I think, for investors that have seen their tech-heavy portfolios cop it in recent times. And I think that there's a big sentiment play out there at the moment. But look, if some of the positive predictions that I've talking about for the economy do come to pass in the next little while, we could all be pleasantly surprised. However, I think for investors, we're seeing at the moment, in contrast to what's happened in recent times, that resources companies, so mining companies, energy companies, are doing really well, and it highlights the importance of having a diversified portfolio. That when you invest now, we do a lot of work with tech professionals. Probably about 2/3 of the people we work with are involved in tech at some level. And throughout the last couple of years, I spoke to a lot of people that were all in on tech, particularly those people that have really started hitting their straps from an income savings and investing perspective over the last few years. Now, what this says is that these companies are not immune from market downturns. So while there is some good potential for recovery over the next little bit, we should take this lesson into the next market run so that when you do invest, you get the results that you want and you're protected when we do see these wobbles. Last piece for this week is on super funds struggling at the moment. I was looking at some of the data that showed the best performing super fund in Australia has grown by 1.6% over the last 12-month period. But with inflation running at 6%, what that means is that super funds are all going backwards now in real terms. Now, what makes it worse is that only 3 of the top 50 funds in Australia posted a positive return, meaning that for the other 47, that the result was much worse from a negative perspective. So Chant West have just released this data on the top 50 growth funds through 30 June 2022. And I think the fund managers are now rethinking their approach to how they keep their investors happy. Host Plus took out the best fund. This is not advice. This is certainly not a recommendation, but just looking at that list, Host Plus took out the best performing fund. And there's some commentary from their chief investment officer, Sam Silica, really great guy. I've had the pleasure of chatting to him. And yeah, it's super interesting, super smart dude. This fund in particular with Host Plus manages $70 billion with the B. And he mentioned that with the average age of their members being 37, what they do is that they look beyond the current economic cycle when they're investing. And I thought that was an interesting thing to bring up, because this is really something that every investor should be doing, particularly if you're younger and you've got a lot of time on your side. So I think the lesson is that you should know that super is a long-term investment and you shouldn't be reactive in the short term, as hard as it is to look at the numbers, see them going backwards and not get stressed. But if anything, when it comes to super, and I just put out something for news.com.au on contributing to super while the markets are down and then benefiting from the upside, because there is softness in the market at the moment. But with it being long-term play, cranking it now is going to massively pay off in the years ahead. Guys, that's it for me for this week. Hope you found that one helpful. I will catch you on the next one.